Welcome to The Explainer. Today, we're unpacking a massive financial anomaly in the European markets that literally has everyone guessing. We're looking at 3i Group, which is this London-listed private equity giant. Now, on paper, this company has delivered an absolute masterclass in long-term wealth creation. Yet, if you just glance at its recent stock chart, you'd think the underlying business was on the brink of total disaster. So our goal today is to really dig into the data. We want to see exactly what happens when the market's demand for perfection collides with reality. Are we looking at a severe market overreaction to a temporary bump in the road, or is a much larger structural collapse looming just over the horizon? Now, what's really wild about this is this single number right here. We've got a historically premium company suddenly trading at a massive discount. To give you some context, 3i Group has consistently traded at a premium to its net asset value. We're talking anywhere from a 10 to 50% premium over the years, but right now, it's trading at a 24% discount. The net asset value per share sits at £30.30, yet the market is pricing the stock at just over £23. You know, in the financial world, when a company with an incredible track record suddenly trades at a deep discount like this, you're either looking at the buying opportunity of a lifetime or a blaring warning siren that the fundamentals are permanently broken. And this brilliantly illustrates our core paradox. On one hand, we've got the triumphs, right? A 22% return on equity, beating their own targets for 5 consecutive years. Net asset value is up 19%. They've paid out a reliable dividend for 33 consecutive years. I mean, these are the hallmarks of an absolute fortress. But then, on the other hand, you have the collapse. The stock plummeted 43% from its all-time high of £44.50. So how does a company delivering stellar returns suddenly lose nearly half its market value? Well, that's exactly the mystery we're going to solve today. Okay, let's quickly look at our roadmap so we can systematically investigate this puzzle together. First up, the 3i Group paradox. Second, action, the hidden engine. Third, slowdown, cyclical or structural. Fourth, the balance sheet and signals. And finally, the verdict and catalysts. Let's dive in. Chapter 1, the 3i Group paradox. Let's look at the fundamental contradiction defining this company right now. When we explore these stellar fundamentals, you got to remember that earnings here reflect investment valuation compounding, not your traditional industrial profits. 3i Group isn't your typical company just manufacturing and selling widgets. Their revenue and net income are predominantly driven by the unrealized gains in the companies they own. Basically, the estimated price tag of their portfolio goes up year after year alongside the cash dividends those companies kick back to them. So when you see the steady march upward, culminating in that £30.30 net asset value per share, you're looking at a compounding machine that has literally been firing on all cylinders. But the absolutely crucial point here is understanding their structure. It protects them from market volatility and allows them to hold their winners indefinitely. You see, unlike a traditional private equity fund that raises money, buys a company, and then is forced to sell it 7 to 10 years later just to return cash to investors, 3i operates with what we call permanent capital. They don't have a ticking clock. If they find a great business, they can hold on to it forever. And that is a massive, almost awe-inspiring competitive advantage simply because it prevents value destruction through forced selling during market downturns. Moving right along to Chapter 2, Action, the Hidden Engine. Let's peel back the wrapper and look at the massive engine actually driving this entire vehicle, the discount retailer Action. Action operates with a scale of global sourcing that honestly no competitor can match, creating an incredibly resilient business model. We're talking about the single largest non-food discount retailer in all of Europe. They've got over 3,500 stores across 15 countries, raking in $16 billion in sales with a staggering 14.8% operating margin. Get this, 22 million people walk through their doors every single week. That's basically the entire population of Florida buying discount goods every 7 days. Because of this massive scale, they can buy directly from global suppliers in volumes that simply crush the unit economics of any rival. It is a true retail juggernaut, boasting a payback period on new stores of less than 12 months. But take a look at this chart. It reveals an extreme concentration risk. 3i completely ignores traditional portfolio positioning rules by basically making a highly leveraged single asset bet on retail. Even though 3i Group holds 23 other private equity investments plus an infrastructure arm, Action makes up an astonishing 76% of the private equity portfolio by value. It represents roughly 65% of the total net asset value of the entire company. So while they're technically a diversified investment firm on paper, their fortunes absolutely live and die by the success of Action. And this extreme concentration, it's exactly why the market recently panicked. Which brings us to Chapter 3, the slowdown. Is it cyclical or structural? This specific deceleration is the culprit.
Like-for-like sales growth is the holy grail metric for retailers, right? It measures the sales growth of stores that have been open for at least a year. Well, Action was cruising at a really healthy 6.8% growth rate. But year-to-date up to May 2026, that number suddenly downshifted to 2.4%. And to make matters worse, hidden inside that average is the terrifying fact that during a specific 7-week stretch, growth flatlined to essentially zero. In a market that completely expects perfection, a flatlining growth metric from your core economic engine triggers a massive sell-off.
So we have to weigh the cyclical excuses like unseasonal cold against the profound structural fear that this retail giant has finally peaked. On one side, we've got the cyclical argument, the idea that this is just a temporary blip. Management points out that unusually cold, rainy weather crushed their outdoor and garden sales, which dropped 3%, compared to a 27% gain the previous year. They also noted a sharp drop in German consumer confidence tied to geopolitical tensions. But on the flip side, we have the structural fear. Action is currently valued internally at 18.5 times its earnings. If growth permanently stalls, paying that much of a premium makes absolutely no sense, and that valuation multiplier will collapse. If the multiple drops, 3i's net asset value drops right along with it, and the market is currently pricing in this exact doomsday scenario. Okay, Chapter 4, the balance sheet and signals. Let's see how management is reacting to all this. First off, because they hold virtually no debt and have massive liquidity, there is absolutely zero risk of forced selling here. Gearing, which is their debt-to-equity ratio, is at a mere 2%. For an investment firm, that is practically unheard of. Plus, they have nearly 1.9 billion cash and available facilities just sitting ready to deploy. This fortress balance sheet means 3i Group is entirely insulated from wider credit crunches. They aren't going to be squeezed by high interest rates, and they certainly don't need to panic sell Action just to raise capital. It's honestly fascinating to watch the signals management is sending right now. They are broadcasting absolute confidence to the market through their first buyback in 2 decades and some serious insider buying. You know, actions always speak louder than words. 3i Group authorized a $750 million share buyback program, their first in 21 years, and they've already started executing it. On top of that, the CEO personally stepped into the open market and bought $1.1 million worth of stock out of his own pocket. Plus, they just raised their dividend by 15%. This is the literal textbook behavior of a management team that believes the market's panic is entirely unjustified. And this quote brilliantly illustrates the asymmetric math happening right now. Every single time 3i spends £23 to buy back and retire a share that is fundamentally backed by £30.30 worth of assets, they are capturing a massive spread. They're essentially buying a dollar for 76 cents. This creates tremendous underlying value for the shareholders who hold on to their positions, aggressively compounding the company's intrinsic value, while the rest of the market is just looking the other way. Finally, Chapter 5, the verdict and catalysts. Let's look at the immediate future. The clock is rapidly ticking toward these critical dates, which will serve as the ultimate judge for the stock's next major move. June 18th is the ex-dividend date, returning a solid chunk of cash to shareholders. But the main event, the date you absolutely must circle on your calendar, is July 23rd. That is when 3i Group releases their Q1 update for fiscal year 2027. This single document is going to dictate whether the stock rockets back to its historic premium or stays stuck in the discount bin. Honestly, the market is going to ignore almost everything else on July 23rd except for these specific metrics. Everyone's looking to see if the summer weather actually brought shoppers back. Remember, management blamed a cold spring for the slowdown, right? Well, summer is here, and the comparative sales numbers from the prior year are much easier to beat. Investors are going to be looking intensely at the like-for-like sales for June and July, particularly in Germany and France where the drop-off was the most severe. If those numbers rebound strongly to 4% or higher, the cyclical weather excuse is completely validated, and that structural fear just evaporates. So as we wait for this data, we're really left wondering, is this one of the most drastic market mispricings of the decade, or the beginning of a true structural decline? If it's merely cyclical, finding a world-class compounding asset at a 24% discount, backed by massive buybacks and insider buying, is incredibly rare. But if consumers really are walking away for good, that 18.5 times valuation multiple might just be a ceiling that's about to cave in. The numbers on July 23rd won't just tell us about a single company. They're going to tell us the true state of the European consumer. So what do you think the data will reveal?